Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem E13-18 from the Pearson textbook. So this is a serial exercise, meaning that it continues throughout the entire book for Canadian Canoe Company, although you do not have to complete the prior exercises in order to complete this question. So it starts with Amber Wilson. She's the owner of Canadian Canoe Company, and she decides to start a new company that will be operated as a corporation, Outdoor Equipment Incorporated, OEI. This company will sell outdoor clothing and equipment. The articles of incorporation for OEI authorize the company to issue 500,000 preferred shares that pay a dividend of $4 per share and 1 million common shares. So that's some key background information that we're likely going to need in order to solve this problem. And what are we needing to do here? Okay, so one, we're given a list of transactions, and then one is to journalize those transactions. So probably should have had this template already set up, but I'll give myself a journal entry template, date, account, debit, credit. So you should have a template already in your workbook. It should be just located right beneath this. Problem, additionally, there is extra journal entry paper included at the back of your workbook if you run out, or just a piece of scrap paper would work. So just looking at January 1st, that's going to be, of course, the date of the first journal entry. So I'll just populate it here before I even read it. And what are we needing to do? So on January 1st, it looks like OEI issued 50,000 common shares for a total of $200,000 in cash. Well, if I'm going to give myself a cheat sheet, DC Adler, I know cash is an asset. And to increase assets, I debit an asset account. So I'm going to debit cash. Sometimes what it gives us is the per share price, or sometimes it gives us the total amount of cash. In this example, it's giving us the total amount of cash. So I know cash is going to go up by 200,000. Format our numbers so they look a little bit better. Okay. So that 200 came from the first. For the first line, and it went up because of common shares. It's going to match 200,000, remembering debits equal credits. Why am I crediting common shares? Well, common shares is an equity account. And to increase equity, I credit equity. There's an increased number of common shares outstanding, which means that there's an increase in the book value of common shares. Remember, we do the journal entry for the book value of what common shares are going to be on the balance sheet. And that's all we need to do for January 1st. So that was a fairly easy one to start with. And I'm going to mark it as complete, Jan 1. Okay, now it's January 10th, and they issued 2,000 preferred shares in exchange for land with a market value of $70,000. Remember, when a business is exchanging shares in order to acquire an asset, the acquisition amount gets recorded at its market value. Maybe I'm just going to write AC Adler in a little bit of a better format for us. So we know they're exchanging shares in order to acquire land, which is an asset. The market value of the land is 70,000. Since land is an asset, to increase assets, I debit asset. So here I'm going to debit land by 70,000. What are they doing? They're issuing shares, preferred shares. Preferred shares are a part of equity. So to increase equity, I'm going to credit equity. I'm just going to do one last check. I wouldn't imagine the problem would give us a situation like this, but I just want to make sure that they issued an amount that's less than what's been authorized. They issued 2,000 and they're authorized to issue 500,000 preferred shares, which means that they have 498,000 shares they could still issue. Now we're done with January 10th. Okay, so now it's December 15th and declared total cash dividends of 15,000. So this is a good problem for us to do. December. As soon as dividends are declared, we're going to do, and it's a cash payment of dividends. It told us right here it's a cash dividend. It's not a stock dividend. So whenever there's a declaration of cash dividends, we need to reflect the liability, the payable for it immediately. And I'm going to do a little bit of a review for us. We know that dividends get paid out of retained earnings, or at least we should know. So dividends get paid out of retained earnings. So since dividends get paid out of retained earnings, we're going to be lowering retained earnings. So I'm going to lower retained earnings by debiting it. Why? Well, retained earnings is a part of equity. To increase retained earnings, I would credit it. Since dividends come out of retained earnings, I'm going to be lowering retained earnings, which means I'm going to do the opposite of what's in this chart. So I'm going to be debiting retained earnings in the amount of 15,000. Just going to make it a little bit cleaner. Okay. And while there's two things going on here, it just gives us the total cash amount of dividends that's going to be paid. It doesn't tell us what the distribution will be between the common shareholders and the preferred shareholders. Remembering that preferred shareholders have a liquidity preference, which means that preferred shareholders get paid before common shareholders, we're going to have to exhaust the amount of dividend to preferred shareholders first. So it should tell us in the question, I'm going to read the question up here again, to give a dividend rate of what the preferred shareholders receive, remembering that preferred shareholders usually have a fixed dividend rate. So here it tells me they have a dividend of $4 per year. Okay, and what we did is we issued on January 10th, 2,000 preferred shares. So 2,000 shares are outstanding, multiplied by 4 is going to be, hopefully my mental math here is correct, $8,000. Which means we're going to have this dividend payable preferred shares. $8,000. And which means that the remaining 7,000, so we're declaring a dividend of 15,000, 8,000 of which is going to preferred shareholders because they have a fixed dividend rate. It was given in the question, preferred shares usually have a fixed dividend rate. So, which means that the remainder are going to go to the common shareholders. 2,000 minus 8, which is going to be 7,000 to the common shareholders. That's on the declaration date. Now, if it told us, and this is just an aside, if this dividend declared on December 15th, if it wasn't 15,000, but instead it was only 8,000, there would be no dividend to common shares because the full 8,000 would go to the preferred shareholders. Continuing with that example, if the total dividend declared wasn't 15,000, but instead it was 6,000, the full 6,000 would go to the preferred shareholders and they would have dividends in arrears as well. But we don't really need to know that for this question, but we do need to know that for this course. Now we're done with December 15th. And then it's December 31st, and we paid the cash dividends. So I set up liabilities on the 15th, and those are here and here. I credited liabilities because to increase a liability, I credit a liability. Now, since we're paying them on the 31st, we need to lower our liability. So we do with the opposite in this chart, which means we're going to debit our liability account. So we'll be debiting both of these liabilities. to reduce them to 0. Cash is going to go down. Why is cash going down? Well, 1, I need to balance my journal entry, but 2, cash is an asset. To increase an asset, I debit an asset. Since I'm not increasing cash, I'm decreasing it. I'm doing the opposite of what's in this table. Okay, and that's now December 15th done. So what else do we need to do? Requirement 2 is calculate the balance in retained earnings on December 31st, 2022. Well, retained earnings, we know, is the accumulated net income of an organization minus dividends. So we need to know, well, assume net income for the year is $417,000. We need to know what net income is, because referring back to our closing process, so I'm going to scroll down and give myself a little bit more room. Closing process, REID, revenues and expenses close to income summary. Income summary then closes to retained earnings, and dividends are paid out of retained earnings. So that's the flow of how this works. This summarizes the closing process for us. So revenues and expenses close to income summary. This is going to summarize net income for us. Then income summary closes to retained earnings. Retained earnings is the permanent account that has accumulated net income since the beginning of time, less dividends. So what do we have here? We assume net income is $417,000. Remembering from the question, this is a new corporation, right? So that means retained earnings at the beginning of the year is going to be 0. When did they start this? What was the year? January 1st, 2022. Retained earnings is going to be, of course, 0 at the beginning of the year, because this was a new corporation, which means there can't be any prior year's net income. Then we're going to add net income for the year. And net income for the year was given $417,000. So I'm going to bring that down and put it right here. So that's going to be, of course, 0 plus 417 is going to be 417,000. There should be a credit balance in the retained earnings account for 417,000. But there were cash dividends declared. We did this journal entry on December 15th, which lowered retained earnings by 15,000. So we need to bring that down here. Which means that after the dividends are declared, there's going to be a retained earnings on December 31st, 2022 of $402,000. So this is what would be reported as the retained earnings account within the shareholders' equity section of the balance sheet, $402,000. And this here just reinforces our relationship of what we know about retained earnings. We started with the beginning balance. It's a permanent account, so there should be a beginning balance unless the corporation didn't exist in the prior year. We add in net income, and that's what we're seeing with REID, remembering income summary has a balance of net income, and that closes to retained earnings. And then we pay dividends out of retained earnings, so it reduces it. So dividends get paid out of retained earnings. I'm just going to clear this markup because I think I'm going to need the space for the remainder of the question. Okay. And then the final part is to prepare the shareholders' equity section of the balance sheet on December 31st, 2022. So this is requirement 2. And I'm going to put the equity section of the balance sheet just over here. So we should know whenever we're preparing a balance sheet or any financial statement, really, we start with 3 title lines. So this was outdoor equipment corporation. Let me just double check. OEI, Outdoor Equipment Incorporated. And maybe I'll just write INC for incorporated. And then we do the financial statement name, so balance sheet. This is only a partial balance sheet, right? We don't have the information in order to do everything else, because typically what will go on the balance sheet, assets, liabilities, equity. Here, we don't have any information on assets. We don't have any information on equity. So we just, or sorry, on liabilities, but we only are able to do the shareholders' equity section of the balance sheet. So it's only going to be a partial balance sheet. So maybe I'll just highlight that if I can, so that we know that this is a partial balance sheet. But we should be comfortable with using headings and subheadings. So I'm going to start at the shareholders equity section of the balance sheet. And I'm going to use another subheading called contributed capital. So this is going to be the shares that they issued through the year. What did they issue? Well, they issued preferred shares. And we're going to start with preferred shares first because, well, of the liquidity preference. So it's typical or quite standard to list preferred shares above common shares just to indicate that they have, well, they need to be paid dividends first, but in the event of bankruptcy, any residual assets are allocated first to preferred shareholders. And what we're going to do is, well, we're going to give the dividend rate, which I believe was $4 per share. Forgot I had the highlighter on. So $4 is the dividend rate. There's 500,000 shares authorized. And how many did they actually issue? It was 2,000 issued. And the amount that they were issued for, if you're recalling, and let me just go to the actual journal entry, is 70,000. Credited equity for preferred shares in the amount of 70,000. Then what will come next is the common shares. There's no fixed dividend for common shares, so I don't give the dividend rate. All I'm going to be highlighting here is what's been authorized and issued. That's the quantity of shares, the number of them. So looking back, they have 1 million common shares authorized, and they issued 50,000 shares on the 1st. So 1 million authorized. Then they had, it was 50,000 issued and outstanding. And the amount that they were issued for is 200,000. This is our total contributed capital. For shares plus common shares, 270,000. I'm just going to clear some markup so that we can see better what we're doing. But this isn't all that's in equity, right? We have retained earnings are also a component of equity. Retained earnings we calculated below was 402,000. So it just equals 402,000. Those two added together is going to give me total shareholders equity, 672,000. And then I should, of course, be double underlining my final number. And I can do a better job than that. Okay. And now this is requirement 2 done. It was prepare shareholders equity section of the balance sheet and calculate retained earnings. Of course, we needed to know what retained earnings was in order to do that, because retained earnings goes on the balance sheet. So I hope you found this helpful. My name is Kyle. Have a great day.